Man, it was a huge week this week. You had the NASDAQ rallying 7.4%, the S&P 500 rallying 6.4%, and the Russell adding another 6% to the upside, snapping this horrific sell-off that has seen us selling 10 out of the last 11 weeks. So a much overdue bounce. But can we expect the bottom to be in here? Are we now starting to point our eyes towards much higher profits in the days, weeks, and months to follow? Do we have that bottom in, or are we just going to simply see another dead cat bounce that eventually gets sold and we put in new lows in this market? And how lows those go, nobody knows. So we're going to talk about all of that in this video here. I'm going to talk about the S&P 500 in very deep detail. We're going to go through some Fibonacci retracements about how high it can go, because ultimately I don't think we've hit the market bottom yet. I think that we're hitting this quiet period in the market where you're still 5 weeks away from the next FOMC statement. You don't have earnings, or at least the bulk of big tech earnings, coming out until late July. And it's still a while now until we get the June CPI report. So there's this quiet period. Yes, there will be headline risk here and there. And the biggest risk right now is probably companies coming out with earnings guidance warnings. And that's one of my biggest fears right now, just trading individual stocks, because we have yet to see that wave kick in. So I've been trading more on the ETF front. In fact, Wednesday this past week, I bought QLD to start playing that bounce. I wasn't sure if we were going to ultimately get that this week. I thought we were. If you watch some of my past videos, including the live stream on Wednesday, I talked about that. I thought we were setting up for a bounce here in the coming days. We got that bounce, and now we want to see how high that bounce will take us. We don't have to be predictors of where we're hitting the top of the market or the bottom of the market. We just want to get the meat and potatoes of the rally. We want to get the big chunk in the middle, and that's where the most profitability is. That's the easiest path higher. Trying to time bottoms and trying to time the tops, that's where a lot of people get themselves in trouble with a lot of unnecessary losses. So I got into QLD this past week. I wanted to get into some more SPY on Friday, but I couldn't just because it was rallying 2% right out of the gates. It was gapping higher and I didn't want to chase. I was looking for a pullback, never got a pullback intraday to be able to pounce on. So I have just QLD, which is a 2-to-1 inverse ETF of the NASDAQ 100, and I continue to play on right in that higher, as I've already taken about 1/3 of the profit off of that position for about 6.4%, sitting on about 8.5% in gains on the remaining position. So let's go ahead and get right into the S&P 500 here. All right, that being said, let's go ahead and look at SPY here. So this support level that we have been talking about on SPY has really been the guiding force during this entire sell-off. But last week, we saw a break below the support level that put into question, okay, are we about to see the huge next leg lower? Well, oftentimes when we break a significant support level that kind of like takes your breath away in a sense, it's usually a way to suck in a lot of short sellers into buying this break, and then you squeeze them back up to the upside. So right here, we had about a 2-day break here before we saw this massive short squeeze this past week, causing a lot of people who shorted right here at these lows of the market to have to cover and fuel that rally higher. On the Qs though, Qs never confirmed, and that should have been the first warning signal not to take that break seriously, because on the Qs, we were playing perfectly off of this support level, bouncing off of it each and every time. And that's exactly what we got this past week. So the Qs have really followed the support level really nicely and did not budge on being able to hold it. But the SPY did. But like what we've seen with head and shoulders patterns over the last 12 years, it's not uncommon to the short side to see a quick break of major support and then rally the troops right back up, reclaim it within 1 to 2 days, and make the short sellers look very foolish for doing so. Now, I came into the week with QID and RWM. That's bearish positions on both the NASDAQ and the Russell 2000. On Tuesday, when the week started off, we had this nice gap higher, which caused me to go ahead and get out of the last fifth of my positions in both of those stocks. I had already sold about 80% of my position, but then on Wednesday, I went ahead and added QLD, which I wasn't sure it was going to work based off of that nasty sell-off that we got at the end of the day on the Qs and on SPY. But Thursday it managed to rip higher, and then the continuation of over 3% in gains in the NASDAQ on Friday, that really just shot my QLD position through the roof. So I took about 1/3 of my position on QLD off at about 6.4% in gains, and now I'm sitting on a 2/3 of a position with about 8.5% in gains. So overall, really good week for me in trading. Glad I got out of QID. I followed my stop losses, followed my trading plan. Once it crossed back above that 5-day moving average, I was like, peace out. But now I want to go ahead and take a look on SPY. Now that it's managed to hold the support level, where else do I see this ETF rallying to the S&P and the market as a whole using Fibonacci retracement levels? So there's two schools of thought here on the Fibonacci's. You can use it off of the most recent sell-off, which would have been off of the June highs, which is about 7 or 8 days of solid selling that makes up the whole sell-off. Using that, we're at about the 50% retracement level. So most of your sell-offs, when you go back to 2000, 2008, 2018, 2020, most of your retracements are going to be around, 50 to 61.8% in the retracement department. Sometimes it'll be 38.2 if it's a very, very weak market and the market just can't find any bids. But more times than not, it's usually between the 50% retracement level or the 61.8 retracement level. Right now, we're sitting on the 50%. So unless this market completely runs out of steam next week, this is as good as it gets. I actually think it will go higher, and I think we'll see that 61.8% retracement level get tagged as well. But I'm also working off of this much bigger picture here now that we've hit the 50% on the shorter time frame. I want to see, okay, can we get to the 38.2% on the longer time frame that works off of the highs from March? Then if that happens, then you're looking at a move that coincides with the short-term and longer-term views on the Fibonacci retracement levels of somewhere between 396, which would be the 61.8% retracement level on the sell-off from June, and the 38.2% retracement level on the sell-off that started back in late March. So that would put us between 396 and 400, like I was saying. So what I'm looking for is taking profits along the way and letting my remaining position that I still have do the heavy lifting. Maybe I'll be able to add some more positions next week if this market rally looks like it wants to sustain itself. But along the way, I'm going to be taking profits so I can secure my capital and be able to consistently profit from the market as a result. Looking at the longer term view of SPY, the 50% retracement level is going to coincide with the June highs. That's going to be a very, very difficult area to break. But along the way, and we did this on Wednesday, we filled this gap here on Wednesday. I'll show it to you by just drawing a quick box around it. This box got filled. This was the big gap down from June 13th. We filled that gap. Now we have a second gap that we need to fill right here. And this is from June 10th. We can fill these two gaps there. That would be huge. But the real resistance is going to come if we are able to get back up to this 50% retracement level. And this is where I ultimately think that we're going to see this rally take us to. And by getting there, we're going to encounter some heavy resistance right there. Now, the best case scenario would be, let's zoom out a little bit here. Let's go ahead and get rid of the Fibonacci retracement levels. Is if we can come back and test this long-term declining trend line off of the January highs. It has only been tested one other time. That goes back to the March highs that we made. Incredible rally. We haven't seen any rally like this rally since. And it's been over 3 months. And bear markets are filled with massive short squeezes and huge bear market rallies. And we are well overdue for one, especially considering the fact that the markets are down 10 of the last 11 weeks. That's almost 3 solid months of nonstop selling. So I do think there is a potential that if we can break through this 50% retracement level, that we could see that ultimate move to the top end of that declining channel. And with it being summertime, we're also seeing a lot of very light volume levels. And light volume is usually very conducive to a market rally, especially in this kind of market environment that we're in right now. Most of your sell-offs happen on very strong volume, but with so many people on vacation right now, and with it being a historically low volatile period for the markets, there is a good chance that we see this market rally continue up and until late July when the earnings season starts, and that's a whole other batch of fireworks that we'll have to deal with at a later time. But with all bear market rallies, you have to take it with a grain of salt. You can't just sell yourself out to the hope that we're going right back to the all-time highs, that we're gonna, be like the Wall Street Bets crowd and orbit Mars or whatever. We can't take these false hopes and apply it onto the markets. The market doesn't care about what we want or what we dream of or what we hope to get out of our positions. What we have to do is take what the market will give us, book profits along the way, because we never know when the market's going to make its next turn. We can forecast, we can make predictions, but ultimately we have to let the market tell us what it ultimately wants to do. I came into the week QID, I came out of the week with QLD. That's being bearish in the beginning of the week, being bullish at the end of the week. Did I expect for that to happen? No. I didn't know what was going to unfold this week, but I just followed the market's action. I followed what it was trying to show us. And when I started seeing an inverse head and shoulders pattern forming on the Qs, that's what ultimately led me to getting into QLD. And so I have to be willing to put my own desires and my own wishes to the side and really just follow what the market wants to tell me. And if we can do that as traders, if we manage the risk along the way for the times that we are wrong, and we'll be wrong plenty of times. Trading is not easy, and most people will not succeed in trading. And many of the people watching this video will not trade successfully in their lifetime. But the reason why they don't is because they don't manage risk. And they get so caught up in having to make these outlandish profits on one trade or two trades or in every trade that they make, that they fail to do the most important thing, and that is to manage the risk. And if we just manage the risk in these markets, when the markets are most volatile, I scale back on my number of positions that I'm trading. I let the volatility do the work so that I can reduce my emotions and reduce the stress that the market's creating from being a very volatile situation, and let the volatility actually work for me rather than against me. So if you enjoyed this video, I'd encourage you to like and subscribe. Make sure to click join button down below so that you can get all my stock market research each and every day. It's such a great opportunity to see what I'm thinking, what I'm looking at each and every day in the trading market. That's going to include my watch list, both bullish and bearish, my setups that I'm following each day, as well as some of the most intriguing charts and technical analysis that you can come across, as well as updates on the indices and all of the big tech stocks as well. So check that out. And tell me in the comments below, what's your forecast for the next week? Do you think we're going higher? Do you think we're going lower? How do we go into the July 4th weekend? Tell me down in the comments below. Thank you guys, and God bless.